Real estate development is one of the most lucrative business models in the world. Real estate itself is one of the greatest creators of wealth. Just look at the Forbes list. And development within the world of real estate is the highest form of leverage, meaning you can make the most amount of money and have the most amount of success. With that, though, real estate development is not only one of the hardest models within real estate, I believe it's one of the hardest business models in the world to start and scale. It's very challenging. To understand why and to understand what solutions there are to maybe get around that challenge, you have to understand deeply how real estate development works. So in this video, I'm going to explain how development works, and it will show you clearly why it's so lucrative, and then why it's so hard, and at the end, a little bit of what are the ways to sort of solve for that unique challenge. Now, just to back this up a little bit, my name is Buck. I founded my real estate development company, Humn Capital. We focus on boutique hospitality, so hotels and most recently restaurants. We have 7 projects under development or open. We've opened our first 2 last year. We have 3 more opening this year, and then a few that we are fundraising for currently. I've been doing this for 4 years, and prior to that, I worked at JP Morgan and BlackRock. So how real estate development works. At its core, real estate development is identifying a property, formulating a vision for improving that property or adding to it or an entirely new development, spending the time and money critically vetting that plan, including securing that property, and then packaging that plan, raising the capital, and managing the execution. So what that looks like is sourcing, so finding a piece of land or finding an existing building. For me in particular, in hospitality, a more creative sector of real estate, a lot of time spent on the concepting. So looking at the market, both from an industry perspective, what's going on with your competitors, as well as from a geographic and regional perspective, both the key drivers of a market as well as the competitors, and using that to formulate the beginnings of a plan, meaning what is going to happen with the real estate? What are you going to do? What does that look like in terms of square footage and the layouts, etc.? And what does that look like from cost and return perspectives? Then you are going deeper into analysis once you sort of find that direction, proving it out, vetting it out. And then you move to fundraise. And after the capital is secured, really the job of the developer is to manage the execution going forward with vendors and contractors underneath them. That's architect, engineers, designers, general contractor on construction, etc. Now, the tricky part of development, why it becomes so hard, is all of this really can be done if you have the skills by one person or a small group of people. Where it becomes really challenging is that somewhere along the way, specifically up here, you're not just spending your time, which anybody can put forward any new venture, find the time and the margins of your time outside your job, outside whatever revenue generating activities you're doing in your base business. You can pursue new deals with just your time, but it doesn't take that. It takes money as well. So you are spending money on pre-development and pursuit costs. That is simple things like site visits, flying or driving out to properties to search for new opportunities, on architects, engineers, surveys, legal costs, etc., as well as usually a lot more money to secure a property. You can go through this entire process without securing the property, but that's very risky in its own sense because you can spend months, years pursuing this, doing all this work, and somebody else could come in and buy the property from underneath you. Securing a property is in the form of a deposit, if not buying the property. And depending on how big your development is, this can be hundreds of thousands, if not millions of dollars. That's the first reason why it's so difficult. There's another. Why it's so difficult to start, because you need those resources or you need to partner in order to get those resources. But actually managing this and even managing the execution is not that challenging. I would say, having done a number of different business models from e-commerce to technology to development, though it moves slow, it's probably one of the easier things to do in the world of business, managing a singular development from start to finish. Now, you got to understand how this works from a getting paid in a business perspective. In basic, simple terms, you have a piece of real estate, a general partner, a sponsor, a developer is the impetus for that deal happening. They have the vision, they formulate the plan, they package that plan, bring it to investors, bring in these limited partner investors. They're limited partners because their risk is limited. The general partner takes on general liability, usually in the form of securing the debt. And then the developer is managing that plan going forward and dealing with the investors going forward. In return for doing all these things, developers get two things. Number one, fees. There's a couple different types, but they make some cash. And really what they're looking for is a promote, which is a much outsized ownership in the property than the capital that they're putting in, typically achieved after some preferred return back to the LP investors. But at the end of the day, developers are typically putting up 10% of the overall equity and getting closer to 30, 40, 50% or more of the deal. So to visualize this or to understand it, let's just say you have a $20 million deal, and this is broad strokes. $8 million of that is equity. The developer has to come up with that $800,000, so 10% of that equity. So again, another challenge you could probably add up here is in the fundraising, you need that GP commitment. They come up with that 800,000. Oops. Close on the deal. Let's say it 3X's. This is putting aside everything to do with timelines and cash flows. Let's just say it's a 3X. So $60 million. You're left with $40 million after you're paying back that basis in the form of both the debt payback and paying back the investors. Typically, return of capital at a minimum, if not also a preferred return. So preferred return is typically something like 10% of the invested equity over the time that it's outstanding. So 5 years, let's say it takes to 3X. That might be generous, but it's possible. So 5 years times 10% of the equity is $4 million. Out of that $40 million in profit after return of capital, you give $4 million back to the LPs or to the investors, you're left with 36. The GP, who typically I like to structure deals where the GP is pari passu with the LP. So their $800,000 is also getting paid back and is getting the preferred return of 10%. From a GP perspective, purely for sweat equity for all of the roles that I mentioned, the GP then gets anywhere from 30 up to 50%. Sometimes it tiers up as you hit certain thresholds. It's called a waterfall. You can get $8 million as the GP out of this deal. This is a $20 million deal. So as you look at this, $8 million is a great result. That's something that people in other operating business models may spend years, 10 years, decades working on to achieve. And though real estate moves slow, it can take years of pre-development and years of development. It is certainly not unreasonable to say that you can do many deals in your lifetime. And not only that, you can move up from $20 million deals to $100 million deals and beyond, really without that much more scale needed in terms of labor, resources, other than capital. And if you can leverage up with certain partners and structures to get that capital, a small team of people can take down a $100 million deal just as easy as they can a $20 million deal. And a lot of people say a bigger deal is easier. And I've seen this even, at smaller numbers down here. I've seen this as I've moved up. It's easier to get capital, to attract professional investors, attract capital that is frankly more sophisticated and easier to deal with, to get better contractors and vendors and designers on the project. It becomes easier with scale, not harder. Like scaling an e-commerce business to $500 million is a lot different than going to a $500 million real estate development. So that's what's so exciting about development. You can move then to developing deals over time, thus creating a development company. You can develop one-off deals where you're raising money at each individual deal level with different investors. You're getting paid in the same way. And then eventually with scale, if you'd like, you can move to a fund model where you're raising into a singular vehicle and you are investing out of that vehicle. Still, the business model is essentially the same. It's just a matter of scale. Now, why is this so challenging? Like I said, one person, me starting out, you can do a lot of these steps yourself. I wouldn't put them in green over here because they're not free. It takes a lot of time and effort, but you can do steps 1 and 2 with little to no resources. Step 3 is impossible with little to no resources. And step 4, the key part of it, packaging a plan is not that hard. Raising that capital without the resource of, time and patience and network and connections is really hard, if not impossible. And then you go back to managing of the execution, which I put as green because yes, it takes time, but typically by that point, you are in the green, you're getting paid, you're getting some fees out of a deal. And this problem becomes especially challenging if you're looking at doing multiple deals over time. In a business model where you're in the red for so much of the process, it is very challenging to have multiple projects following back to back or going on at the same time. How do you have the resources to spend the time, but also the money on each deal? Now, what people typically do, the green here is what can be handled by any person or any development company, even one starting out. What you can't handle is 3 and 4, and what you're doing is you're bringing in co-GP partners. But even though these are the parts of the deal that take the least amount of time and effort, but the most amount of resources, just this big hurdle, this mountain of upstart resources needed, these partners who are managing those parts of the development get the lion's share of the GP, so that promote. And that number we said in that example of $8 million, if you're splitting up your GP partnership, you can drop to $2.4 to $4 million, even though you're really doing the same amount of legwork as if you owned the entire GP and did every step in this process. What's missing is the resources to pursue a deal, spend the money pursuing a deal, secure the property, and raise the capital. Now, I have spent a lot of time thinking and strategizing and setting up my business to do this differently, to find a way to own as much of the development process as possible, potentially even the raising of capital, if not potentially the securing of property, or just bringing in partners as late as possible in as limited of a role as possible so that I can own the most amount of every partnership as possible. Now, there may be some scenarios where there's strategic partners that you may want to give GP to, but if you are doing or capable of doing all the true work that needs to be done, if you can simply solve for the money problem in the pre-development process and build a network for the raising of the capital, you then have the choice of what you want to give up, who you want to partner with. And that, for the same amount of effort, if you can set up a solution for this ahead of time or over time, you can increase your stake in any given deal that you do by 2x or more, depending on how the deals are structured. So that's why it's challenging. That's why there's so much leverage in real estate development and why there's so much leverage in figuring out how to solve for this core problem. The way that it has been done forever has been starting and running a coordinate operating business alongside your real estate development efforts. It's why real estate development is so challenging. It's the only business where to start and run your business, you need to start and run another business. The business models that exist and are common in this space are not the most optimized. I am setting up my company to try to do it in a new and different way that is more optimized and higher leverage to get the results that I've laid out here. I'll do a second video on that, but this is the basic premise of how real estate development works, why it's so challenging, and what needs to be focused on in order to solve for those core challenges that can open up much more success long-term and into the future. Thanks for watching. Go ahead and subscribe to this channel if you found this interesting, informative, or entertaining.